So let's start with lending, which is so important to Bank of America, really a leader in commercial lending. And net interest income is something we've been talking about an awful lot. You had said it would be a trough in all likelihood second quarter, coming back fourth quarter. But I'm curious about when you look at it, what are the things driving that right now, up or down? Is it loan demand? Is it the cost of deposits? What are the things that are feeding into that right now?
Yeah, so I think, make it straightforward. We have $1.91 trillion of deposits, and we have about $1.05 trillion loans, $1.05 trillion loans. And so the money we earn on spread, net interest income, is the difference between what we deposit rates paid, loan rates received, and then ultimately investing in cash, the other $800 billion we have to invest. So first, what's driving demand, I think, is actually an interesting thing. So if you look across the loan categories, credit card growth was decent. Home equity growth is kind of bouncing along because consumers aren't using their home equity loans yet. They may. Mortgage lending activity are relatively flat there. You go on the commercial side, the great news is we grew small business and business banking, which is our $50 million segment. It grew for small business for the 20th consecutive quarter. We're the #1 small business lender, despite what you hear. We are the largest small business lender in America, and that grew, which means there's activity. But when you get into the middle market and the upper end, you start to see that there's a little of a softness in loan demand because of opportunity and cost, to your point. The cost of borrowing is higher, and the opportunity what to do with the money with economic uncertainty is higher. But you put that together, we believe that NII would trough this quarter. We called that. We showed a bridge where it goes from $13.9 billion this quarter to $14.5 billion in the fourth quarter, and we showed the steps to get there, which I think gave the market confidence that part of this requires a little bit of growth in loans and deposits, continued discipline and pricing, but a lot of it comes from mechanical repricing of assets that are rolling off their fixed rate and having them repriced to current rate structures.
Yeah, and those mechanical things you're reasonably certain of as much as you can be. But when you talk about growing, for example, small and medium-sized business loan, is that what I would call organic growth? Is that more customers, or is it current customers actually borrowing more?
Well, it's both, but it's probably weighted in the small business area to more customers now. In the middle market area, it's driven a little bit by line usage, the percentage drawn on the line on average, and that's our average loans. And so in small business, we're adding customers. In middle market, we're adding customers. And in large corporate, really people don't use their lines much in the markets being strong for fixed income underwriting. Take the assets away from us. So it's across all that. So if you look at small business, our activity, i.e. new borrowers, is high. We have a big practice lending to dentists and doctors, and that's been growing pretty well. And we have just the general small business credit card, which is to do their operational stuff, a business credit card and small business. You can see that growing. But middle market line draws are basically relatively bouncing around at a level that is still about 5 percentage points below where it was pre-pandemic, which means that as cost of borrowing went up, people aren't being quite as aggressive, and that's why the economy is slowing down. They're not hiring quite as many people. They're not buying that piece of equipment. They're not doing it because they're a little worried about final demand, and therefore they're being careful, which is unpleasant for your bank, but is okay because the companies are still making profitable and the credit quality is good.
Yeah, and the Fed needs to slow it down a bit given where we're with inflation. At the same time, from where you sit, because you have such a vantage point into this, is that a straight line that's going down? Do you see it leveling off, or is it?
It's a flat line. So loans grew first quarter, second quarter, a few $1 billion on a $1.05 trillion base, so say $8 billion. So they grew a little bit. All the business lines grew loans, but the wealth management business grew faster, which is good because wealthy people, as their asset base goes up, tend to use it to do something a little more faster than a corporate might. There's not a lot of leverage finance going on. There's some, not a lot, because deals, the higher prices and multiples and getting it all straight, that'll work itself through the system, and you have a lot of people on your show who are private equity colleagues that, they're sitting there saying, I've got lots of money. I can't find the deals at the right price. That's the key, at the right price. They can find deals. And so that's a little bit muted. But if you look across the board, it's solid, growing a bit, but growing consistent with the lower growth, 2% type growth, lower inflation economy. It's not growing as fast as it was coming. The pandemic shot up, went down, and started growing faster. Same with deposits, went up, drained down, they're stable. The activity is kind of normalizing now, and that's where I think the risk of the next turn in the track is actually getting the timing right to bring the rates down to create a little more accommodation in the system, or a little less restriction.
What are your projections on the rate cuts?
Our company's projection, our research team, which is terrific, Candace Browning, Platinum Research Team, best research team in the world, has really won this year. They had just in their last report said we're probably going to come off of that. So like they usually do, the day I get on TV, the next day they change it. But the market's at 3, we're at 1 somewhere in that. We'll see where they'll come out, is my guess. But
maybe more important than that is, where do you think we end up? Because that's the question. We could do it this year, next year, but where's the long-term interest rates going to end up?
So if you think of across time here, that's what's important, is that our teammates think that we end up around 3.5. And that's where the Fed stops. That is a wholly different environment than the last 15, 20 years, where, basically there was no interest rate, got up in 16, 17, 18, 19 to 2.5, and then it was cut, if people forget, at the end of 19. We never got back to, quote, a normal rate environment that you would have seen in our early careers for years, David, where the Fed funds was 3.5 or sometimes even a lot higher. 10-year rate was 4.5. That normalized rate is where our teammates think it gets to. And Candace and her team is saying, look, they bring inflation down, and then they'll stop because the core underlying growth dynamics, the amount of money in the system, the fiscal borrowing that went on is still being deployed, the IRA, the Infrastructure Act, all this stuff going on is going to still be coming through the system. A lot of it's not spent yet; it's being spent. That will create, tight, demand and things like that. Therefore, there's probably going to be a little more inflationary pressure. But it would be good for America if we ended up with a more normal rate structure and a growing economy. That 3.5 didn't become too restrictive. That would be good, because that's a much sort of healthier place for us to be over time.
At the same time, if 3.5 is where we're ending up, let's assume that for a second. That suggests that where the Fed is now is maybe not as restrictive as some people think it is.
Yeah, I mean, there's great debate about R-star and the natural rate, the long-term rate, which the economists can go on, but I think they're restricting. When you hear from clients, they're saying, hey, it's costing me, what used to cost me, 200 basis points over 50 basis points, or 300 basis points over 50 basis points, 3.5%, is now 300 basis points over 5.5%, 8.5%. They're like, so it has a restrictive effect. They've got to slow that down, and that's why you're seeing the borrowing demand come down and deployment of that borrowing. You're seeing consumer movement of money in our franchise come more consistent with a lower growth, low inflation economy. All that is going on, and that's where the next turn in the track is a trickier one. They've put inflation on the right path. What's the debate about too far or not far enough? And that's going to be what the market's going to ebb and flow on a given day.
So what about the cost of funding for you for your deposits? Because you have to spend some.
203 basis points.
But I read some accounts in some places, people are rotating, as they say, into higher yield products, which cost presumably Bank of America and others more money. Yeah. Are you seeing that rotation? Do you see it tapering off or ending? Yeah,
so we showed some pages today. It depends on the business and the use of money. If you look at the core consumer business, the rate paid really reflects a huge amount of non-interest checking as a percentage. So it's a mix of what the customer uses the money for. You go in the investment business, we're still seeing a little bit of rate increase. You go in the client business, the banking business, global banks, corporate customers. Basically, the year-over-year, the quarter-over-quarter change is next to nothing, because it basically priced up to the difference between it and the Fed funds rate and sitting there. So it really is business and how the customer is using the money. We sort it by transactional money and investment money. And then if the customer is in transactional money, that money is moving around. They don't see it. In investment money, they're making a discrete decision. Do they want to leave it with you, or do they want to put it in a money market account? And that's where you saw some of the movement happen. And that's what's been going on in the wealth management business. Across all our platform, deposits have grown for the last 4 or 5 quarters, ever so slowly, which means the stability in pricing is there, because the rate increases linked quarters 10, 12 basis points, which is really just a little bit of mixture.
You have a unique perspective on the consumer, U.S. consumer. Give us your take right now on the consumer. I see in your numbers you're taking more provisions than you were. You have more charge-offs. Do you see that continuing?
So if you talk about it from a credit standpoint, the credit card charge-off rate for cards was like 3.88, I think, this quarter or something like that. We underwrite to stay under 4.5 in normal times. So the point is that it's just been coming back up to the level that it was in prior periods. It's a little bit higher than it was in 19, but that was like a 50-year credit low in the company's history. So it's normalized, but the rate of increase is interesting. Year over year, I think it's up 80 basis points, or so everybody's like, oh my gosh, but it's just getting back. So what we showed today is that we showed the early stage of delinquency, what they call 5-stage, or 30-day delinquency and 90-day delinquency, it's basically flattened out, which means the second half of the year, you'll see the charge-offs flatten out, which means we've reached normal 4%. So from credit, they're doing well.
We haven't mentioned trading. You had quite a report on your equity trading. You're really doing terribly well. What do you do to keep that going? Are you going to invest more in it?
We continue to invest along 3 dimensions. Technology, Jim DeMar and the team run it, and they've done a great job. And so 5, 7 years ago, we made the decision to give them more capabilities. Technology, the balance sheet that they can use to help their customers achieve their goals, and talent. And so Jimmy across the board continues to increase. And so we feel good about it. He made $1.4 billion after tax this quarter, which is a very strong earnings quarter. But what's happening is you're seeing back-to-back billion-dollar-plus quarters. We're used to be $1 billion plus and drop to 500 when the markets slow down. You're seeing much more stability. The break-even point in the business is, on a relative basis, much lower. The best second quarter they've had since, I think, 2012 or something like that, which a lot of that was just when assets were marked up and came back through the system at profit. They've done a great job. And Tom Montag, 6, 7 years ago, started this. Jimmy took it over, has done a spectacular job of implementing it, and we feel confident. We'll keep giving them more RWA, risk-weighted assets, balance sheet, capital, and investment in technology, because that's obviously very expensive business to run from a day-to-day basis.
Brian, I know you want to grow all the business of Bank of America, but do you have a strategy about the balance between what I would think of as a traditional bank lending, interest receipts, as opposed to the fee side, whether it's investment banking or asset management? Are you rebalancing the bank?
Well, this quarter happened to be half the earnings were from people, half the earnings for institutions. Out of the $25 billion of revenue, 14 was spread revenue, and 11 was, round numbers, was fee revenue. Because the market dictates a lot of the fee revenues, we could do it. But if you think about it from the businesses, in the consumer business, we made a decided decision to lower fee burdens on customers, and the trade-off for that was long-term customer favorability, running 88% across all the platform engagement places. The brand favorability in the 70%, up 20 points over the last 10 years. So we made a decision, lower the fee burden, but get it paid back in transactional accounts. Those are zero interest deposits. That's worked wonderfully. So we grow 1 million accounts a year. They start at $2,000 or $3,000. They mature to $7,000 to $10,000. It's all zero interest rate money. It's very strong, and that's, if it's a young kid, it's a customer of the future, and that's what we're doing. So that balance in fees there. In wealth management, it's all going to be about fee-driven. But the incremental growth, 7% increase in fees year over year, that's what we're driving there. Jimmy has a mix in the trading business, and then, the commercial business is actually balanced. Investment banking fees, which everybody talks about, $1.6 billion, but the whole revenue in the business dominated by lending and deposits for corporate customers. So you have to keep your heads on. We never say, if it's this, we're happy. If it's not, we're happy. We want to grow all aspects of it.